Question 215. All important disclosures that the mutual fund is required to make, by regulation, are contained in the offer document. A. True. B. False. Answer B. False. Question 216. The offer document issued when an open-ended scheme is launched is valid for all times, until amended. A. True. B. False. Answer A. True. Question 217. The most important source of information for a prospective investor is A. Offer document. B. Annual report of the AMC. C. Economic Times. D. Amphi newsletter. Answer A. Offer document. Question 218. An investor need not study the offer document before investing in a scheme. A. True. B. False. Answer B. False. Question 219. The offer document is not a legal document. A. True. B. False. Answer B. False. Question 220. Initial issue expenses are charged to a scheme in the first year itself. A. True. B. False. Answer B. False. Question 221. Scheme-wise annual report of a mutual fund need not be A. Sent to all unit holders. B. Forwarded to SEBI. C. Published as an advertisement. D. Stock exchanges. Answer D. Stock exchanges. Question 222. Mutual funds value their investments. A. At purchase price. B. On a mark-to-market basis. C. At par. D. At book value. Answer B. On a mark-to-market basis. Question 223. Investors are totally exempt from paying any tax on the dividend income they receive from mutual funds. A. True. B. False. Answer A. True. Question 224. Income distributed to unit holders by a debt fund is liable to dividend distribution tax. A. True. B. False. Answer A. True. Question 225. A close-ended has average weekly net assets of 200 crore. As per SEBI regulations, the AMC can charge the fund with investment and advisory fee up to A. 2.25 crore rupees. B. 2.00 crore rupees. C. 2.50 crore rupees. D. 3.00 crore rupees. Answer A. 2.25 crore. Question 226. A passive fund manager. A. Researches stocks extensively. B. Does not buy and sell stocks often. C. Does not have to go through the process of stock selection. D. Does not have to track stocks. Answer C. Does not have to go through the process of stock selection. Question 227. A fund manager managing an index fund. A. Has to keep fund expenses low. B. Does not have to research stocks. C. Does not have to balance his portfolio. D. None of the above. Answer A. Has to keep fund expenses low. Question 228. A growth manager looks for A. High current income. B. Undervalued stocks. C. Above average earnings growth. D. None of the above. Answer C. Above average earnings growth. Question 229. A value manager does not look for A. Stocks that are currently undervalued in the market. B. Stocks whose worth will be recognized by the market in the long term. C. High current yield. D. Long-term capital appreciation. Answer C. High current yield. Question 230. From an investor's viewpoint, the most important is A. A fund's investment style. B. Performance of the fund. C. The fund manager's judgment. D. None of the above. Answer B. Performance of the fund. Question 231. Fundamental analysis involves A. Checking the foundations of the company's factory building. B. Research into the operations and finances of the company. C. Studying the company's share prices. D. None of the above. Answer B. Research into the operations and finances of the company. Question 232. Which of the following is not considered for technical analysis? A. Historical data on the company's share price. B. The company shares trading volume. C. Current market sentiment. D. The company's regulatory environment. Answer D. The company's regulatory environment. Question 233. Quantitative analysis is more likely to be done to evaluate a particular sector or industry rather than any specific stock. A. True. B. False. Answer A. True. Question 234. Fundamental analysis form the basis to decide A. When to buy a given share. B. Whether to buy a given share or not. C. Whether to use technical analysis or quantitative analysis. D. Whether the company's factory can withstand earthquakes. Answer B. Whether to buy a given share or not. Question 235. Technical analysis guides the decision on A. Whether to buy or sell. B. The right time to buy or sell. C. Whether company's technical personnel are adequately qualified. D. None of the above. Answer B. The right time to buy or sell. Question 236. Which of the following is not an investment philosophy? A. Capitalizing on economic cycles. B. Focusing on growth sectors. C. Capitalization. D. Finding value stocks. Answer C. Capitalization. Question 237. When expecting a fall in market price, fund managers can reduce the loss in portfolio value by A. Speculating. B. Not buying and selling shares at all for some days. C. Using equity derivatives. D. Giving TV interviews to improve sentiment. Answer C. Using equity derivatives. Question 238. Equity derivative instruments are A. Shares. B. Bonds. C. Contracts. D. Notes. Answer C. Contracts. Question 239. A futures contract allows one to buy or sell the underlying shares, but need not result in delivery. A. True. B. False. Answer A. True. Question 240. Derivatives cannot be based on market indices. A. True. B. False. Answer B. False. Question 241. In a mutual fund, the overall decisions on allocating money to particular industries/sector are taken by A. Equity analysts. B. Fund managers. C. Security dealers. D. Trustees. Answer B. Fund managers. Question 242. Continuous tracking of the companies in which a mutual fund has invested is done by A. Continuous tracking systems. B. Equity analysts. C. Trustees. D. Security dealers. Answer B. Equity analysts. Question 243. Security dealers of a mutual fund. A. Guard the cabin of the fund manager. B. Execute buy and sell orders for the fund. C. Decide which shares to buy or sell. D. None of the above. Answer B. Execute buy and sell orders for the fund. Question 244. As per SEBI's requirements, each scheme of a mutual fund should have a dedicated fund manager. A. True. B. False. Answer A. True. Question 245. Debt securities bought at a discount to their face value are generally A. Interest-bearing. B. Zero-coupon bonds. C. Paying interest at a floating rate. D. None of the above. Answer B. Zero-coupon bonds.